We'll be starting our webinar in just a minute. We'll give a couple more people are still joining and we'll start in 1 minute. Good afternoon to many of you and good morning to our listeners on the West Coast and Hawaii. Thank you for joining us today for our webinar focusing on the impact of federal relief program packages as part of the CARES Act to the labor and employee benefit plan communities. My name is Brian Garstecki and I lead Withum's multi-employer benefit plan and labor organization practices. Also presenting today is Scott Price and Aaron Slaughter, who work with me in our benefit and labor practices, and Dan Mayo, who is a national lead in Withum's federal tax practice. As many of you know, the federal relief packages presented today have been around for several weeks, and many of the webinars out there have focused more on the corporate for-profit aspect of these programs. Our focus will be on the specific aspects that are most relevant to nonprofits such as multi-employer plans and labor unions. Our presentation will be broken into two sections. Dan will present the relief programs during the first part, and then we have dedicated the second half to a question and answer session. As stated earlier, even though these programs were rolled out several weeks back, this presentation and the materials includes the most recent FAQs and other guidance received from the applicable government agencies. The slide deck can be found in the handout section on your webinar toolbar. To ask questions throughout the presentation, please use the question section on the toolbar. We understand that we may not be able to cover all of them during the Q&A session, but we plan to respond to all and send via email to all attendees. Dan, I'll turn it over to you.
Great, thank you. It's great to be here today, and hope everyone is comfortable in their homes and the shut-ins that we're all experiencing. We're going to talk about a few topics today. We listed them here: the employee retention credit, the employer payroll tax deferral, and the sick and family leave provisions. And these are three tax benefits that are provided in the recent legislation, the phase 2 and phase 3 legislation. And then we're going to talk about some of the SBA programs that are available, notably the Paycheck Protection Program, which is about to be reauthorized today. We expect additional funding of $310 billion for round 2 of the Paycheck Protection Program. And then also EIDL loans, which are also getting increased funding as well today. And then finally, as Brian mentioned, we'll wrap it up with about 35 minutes of Q&A, hopefully address all the questions you have. So turning to the next slide, and again, we'll talk about the employee retention credit first. And this is the employee retention credit is a refundable tax credit that's available under certain conditions we'll talk about in a moment, but it provides a credit for up to 50% of qualified wages paid from March 13th to the end of the year. As you see here, we put links there. So the IRS has published a lengthy series of frequently asked questions, as well as the Form 7200 for advance. If the amount of the credits exceed, it's a withholding tax credit, so that the credit is offset. You receive the cash by offsetting your withholding tax deposits. And in the event the expected credits exceed your deposits, they have this Form 7200, which is a new form the IRS published about a month ago, which enables you to get the taxpayers to get an advance credit and get a refund quicker. So, and the IRS has promised to process those within 2 to 3 weeks. So the credit, as I mentioned, is a refundable credit. It is based on wages, and it's claimed on the Form 941 is how you do it. You reduce the withholding, and then the amount, you adjust your 941 starting in Q2. And there's 2 ways into the credit, and there's 2 requirements. You need to meet one of the 2 in order to qualify for the credits. And the first one is that the operations were fully or partially suspended due to a COVID-19 related shutdown order. And we'll talk about what that means a little later. I know we've had some questions on that. In a nutshell, the IRS interprets that phrase partial shutdown quite liberally, and it was intended for the restaurant industry, and the restaurants largely have are not permitted to have in restaurant dining, and they're limited to takeout and delivery. So, but when the IRS issued their frequently asked questions, they do interpret that phrase somewhat liberally, so it includes any deviation sort of from the normal business operations. And second, there we have the second test, which is the gross sort of substantial gross receipts test, which talks about if there's a decline in your gross receipts, not net income, but gross receipts of more than 50% relative to the same quarter in 2019, then you can claim the employee retention credit up during that quarter. And the period during which you can take the credits will continue until your gross receipts are restored to 80% of the prior year. So in Q2, if your receipts drop dramatically, then you would be entitled. They drop more than 50% from 2019 Q2. You'd be entitled to these credits. 50% of wages up to 10 grand, so a 5,000 maximum credit per employee. And then while in the third quarter, let's say revenue picks up, so it's 90% of what it was in 2019, the third quarter, then you would stop taking credits in that period. So that's the way that those two rules work. So it's an either or test. So if you meet either test, you're permitted to claim the employee retention credit. The nice thing about this credit, unlike many of the other benefits, is it's unrelated to the size of the business or the number of employees. So it's available to everyone. The only limitation here is that, well, there's a limitation on the amount, which is the first thing that says if you're a large employer, it only applies to the wages of the employees who are not providing services. So they can't work or telework due to the shutdown order or partial suspension of business, for example. But if you're a company that is under 100 employees, full-time equivalent is the actual phrase they use, but then it applies to all wages of every employee. So it's much more broadly applied for smaller businesses than for larger businesses. The second major limitation is that it does not apply. This credit does not apply if the taxpayer also claims or receives a covered loan under the PPP, the Paycheck Protection Program. And in most cases, the PPP will be more favorable to taxpayers than the employee retention credit, just because the generous provisions there allow for 2 months of loan forgiveness for each employee's wage up to $100,000, or a maximum of $15,385 per employee. So to the extent you have highly paid employees and the business would receive forgiveness of $15,385 per employee, that's going to exceed the $5,000 value of this employee retention credit. So that's sort of a way to compare the two and see which is more beneficial. The IRS has not provided rules yet on whether a taxpayer can claim this credit, subject to hearing if they obtain a loan in the PPP, where they've applied, they haven't received a decision yet. Let's say they didn't get a loan in round one, but they're going to go for a loan in round two. The IRS has not issued guidance on, as they have with the next one we're going to talk about, the payroll deferral, employer payroll deferral. They've not issued guidance here on whether you can take this credit up until the point where you get the loan. And so that may be coming. We have to wait and see. But in any event, it should be a moot issue within the next 2 weeks, because by then everyone will have had a decision on whether they received a loan under the PPP, given the tremendous backlog of applications. And even though they've authorized, Congress already authorized $310 million. I think the House voted yesterday, passed it. That's going to the president for signature today, I believe. It's likely those funds will be exhausted in minutes, if not hours, of the application process opening up, again, given the tremendous backlog and demand that's out there. Also, the credit is not available, the employee retention credit, to the extent you're funding wages through the sick and family leave provisions of the FFCRA. That's the phase 2 legislation, right? The CARES Act was the third one that was passed. The second legislation was the Families First Coronavirus Response Act, to the FFCRA. And so that's the you can't double dip the credit. So if you're paying your employees sick or family leave through the refundable tax credit that's being paid by the federal government, they don't want you also claiming the employee retention credit with regard to those same wages. And so again, the final point I'll mention here is the way it works is you can reduce your total employment tax and income tax deposits for the amount of the expected credits. And so, for example, if you expect to receive 10,000 in credits in one quarter, and your total deposits are 15,000, you would only deposit 5,000 that quarter instead of the 15, because you were expecting to get 10 of employee retention credits. If, for example, you're expecting 10 of credits, but your total deposits would only be 8,000, you would not pay the 8,000. You would be owed 2,000, and you could file a Form 7200 and get a quickie refund of that additional 2,000, so you don't have to wait until the end of the year. This is designed to be a refundable credit. The goal is to generate liquidity in the marketplace, so they will come quickly, these credits. If we turn to the next slide, we'll talk about the employer payroll tax deferral provision. For those of you who follow the CARES Act, I believe it's section 2302 of the CARES Act. The last one was 2301. If you're like me, these days I have the CARES Act open on my computer 24 hours a day. I have all these provisions bookmarked and refer to them, including the PPP, at least 20 times a day. So that's how I know these sections so well. So this is an employer payroll tax deferral, and this is a really generous provision that almost everyone is taking advantage of that I've spoken to. And the reason why we'll see when we get down to the interaction with the PPP become apparent. This allows employers to defer the 6.2% OASDI, which is a portion of the FICA. Recall that FICA taxes are made up of two parts. The OASDI, Old Age Survivors Disability Insurance, I think I got that right. The OASDI and the Medicare. And so the OASDI is the 6.2% of the employer's portion. Remember, the employee pays it and the employer matches. So this allows you to defer that 6.2% of wages up to 137,700, starting from March 27th to the end of the year. And it's an interest-free loan. And so you get to you stop paying that employer portion of the tax, that 6.2%. And you when is it owed? You have to pay it back to the IRS half by December 31st, 2021, and their balance, the other half, by December 31st, 2022. So it's an interest-free loan for up to 2.5 years, essentially. So part of it's 1.5 years, the other part goes to 2.5 years. It's claimed on the 941, just like the last one, the employee retention credit, and starting in the second quarter. And as we said, the deferral is paid in equal installments over the next 2 years. This one also applies, the nice thing about it is it applies regardless of the size of the business, the number of employees, there's no interest rate. So it's an interest-free loan that the government is providing. And the nice thing that the IRS came out with guidance about, say 2 weeks ago now, and where they said that the way this works is if a taxpayer receives a loan and then gets forgiveness on that loan under the PPP program, they're not eligible for the payroll tax deferral anymore. So if you recall, the retention credit was keyed off of obtaining a PPP loan. This one here, the employer deferral, is keyed off of not just getting the loan, but getting forgiveness on the loan. And so what the IRS said about a week or two ago was taxpayers can take this payroll tax deferral, which will give them liquidity to manage to pay their expenses for the next few months, and they can continue this deferral up until the date they get a decision from their lender on the forgiveness. So that and that decision is not likely to come until November or December of this year. So while this deferral goes from March 27 to the end of the year, even if you get a PPP loan and get forgiveness, the IRS is going to allow you to defer all amounts paid up until that point, which is in all practical purposes, amounts paid through October, November, and December, or some portion of that throughout the year. And then at that point, it stops. Once you get a forgiveness decision, you can no longer defer any additional amounts, but the amounts that were deferred can continue to be deferred until the end of 2021 and 22, just like the regular rules. So it is a very effective provision. And again, the IRS is interpreting it generously to allow taxpayers to take this immediately until they get a decision. Just very briefly, we'll cover the PPP later. Now, the reason why I say it'll take you to the end of the year, let's just say a taxpayer gets their PPP loan May 1st. The 8-week period would expire approximately end of May, end of June is the end of the 8-week period. Then they would have anywhere from 2 to 3 months to file their PPP application, forgiveness application with the lender. It's, let's say, 3 months. That takes you to the end of July, August, September. The lender then has 60 days to render a decision on the application for forgiveness. So that takes you to the end of when do we say, end of September, so October, November. That takes you to the end of November, if I did that right. Did I mess up the dates? I saw a look from Scott like I might have. Hopefully I didn't mess that up. In any event, it's going to go to end of November, end of October, November, in many cases even December, depending. The real driver is when the loan is obtained and when the application for forgiveness is filed. There's no deadline as of yet as to when that must be filed, but we expect forgiveness guidance in the next 2 days, substantial guidance. So this is a very favorable provision. The one last thing I'll mention regarding this is the tax deduction. If you don't pay the 6.2%, you take deferral under this, you won't get a tax deduction for it. And so the deduction will be deferred until the payment is made. It has to do with Section 461 and when economic performance is considered. I won't bore everyone with the details, but for those of you who know those provisions and care, that's the reason why you lose your deduction or defer your deduction until it's paid. There is a way to speed that up. If you pay it by within 8.5 months, the end of the tax year, you can get it in the prior year under a recurring item exception. So we'll turn to the next slide. And here we're going to, thank you. We're going to talk about paid sick leave and family leave. And these are provisions that came in the phase 2 legislation, not the CARES Act, but this FFCRA legislation. And at a high level, what this does is it requires employers with under 500 employees to pay sick leave and family leave to all their employees. And the reason they did that was because Congress believed that larger employers provided this benefit, smaller employers did not. So they put the onus on employers, smaller employers under 500, to pay these benefits. But then Congress said, we will reimburse you, employer, for these benefits through a refundable tax credit. And so the government's essentially paying the sick and family leave and using the employer as a conduit. So there should be no cost to the employer as a result of paying these benefits. And again, the goal of this and other benefits we've seen from the government is they recognize the shutdowns imposing a severe hardship on many people. And the goal of this is to put money in people's pockets so they can pay their bills. So turn to the next slide. And I'm gonna go somewhat quickly through this provisions. I want to leave time to discuss the PPP and more importantly, answer questions. I know we've already received a bunch of questions in advance. There's always a tension with these webinars. Is some people say you go too fast and some people say you go too slow, and it's hard to get it just right. And so there's a balance we strike between. Usually we include very detailed slides so you have the information if you want it. We try and cover the important stuff and then leave time for question and answer. So I apologize if we're going too fast. I apologize if we're going too slow. And I'll say thank you to everyone who's happy with the speed and appreciates that there's a tension here. So the paid sick leave, what kicks in, what requires the companies to pay the sick leave and family leave? We get a lot of questions around this because people want to know, and people who are going out on work want to get paid, and the companies want to pay them, but they want to make sure that the government's going to fund the credits. So there are six reasons. Really, the 6 ones that catch all. It's any other item that the Health and Human Services declares. So we'll leave that off for now. There's really 5 that are listed in the statute. The first 3 relate to the individual, and the second 3 relate to the individual caring for somebody else. So the first 3 relate to the employee. So an employee is entitled to sick leave and family leave if the first 3, either they're subject to a quarantine or isolation order, and this has been interpreted broadly by the Department of Labor and by the IRS. 2 is they are advised by a healthcare provider to self-quarantine due to COVID-19, or they're experiencing symptoms and seeking medical diagnosis. So those are the first 3. The second 2, the number 4 is in 4 and 5, 5 being the more significant one, which is what most people ask about. 4 is if you have a bona fide need to care for an individual who is quarantined. It's somewhat, time limited. They're not going to be quarantined for 10 weeks. Maybe 4 or 5, but the period of the illness and then a week or 2 thereafter. But number 5 says if an employee is caring for a child under age 18 whose school or place of care has been closed, or the child care provider for that child is unavailable due to COVID-19. And this is what we're seeing a lot of. But I remind you that lead-in sentence right after paid sick leave says the employer is required to provide up to 2 weeks of sick leave for employees who are unable to work or telework. So if an employee can work at home, they're not entitled to sick leave. And if they can telework, which sounds like a somewhat antiquated concept of the idea of telework in the age of internet and Wi-Fi as we have it today, but the IRS is a little bit behind in their times. They recently also put up a nice procedure for speeding up NOLs, and they set up a fax line, which you gotta love. In the age of internet and email, they set up a fax line. They're not even able to accept documents by email. Anyway, you gotta love the IRS, but they're a little bit behind the times. So who's not covered? An employee who can't work or telework is not covered if it's due to a workplace closure or non-COVID-19 issue. So note that these 5 items above are somewhat restrictive, and you need to fall within one of these 5 in order to qualify for the sick leave or the family leave. Family leave is similar. I put there on the bottom. It provides up to 10 weeks of leave after the first 2 for sick leave. There is an additional hurdle in order to qualify, the employee must be working for the company for at least 30 days. So let's turn to the next slide, please. Again, I know we want to be conscious of the time, so we get a lot of time for the PPP, which I know is a very hot topic. Sick leave here, I'll mention, the leave is, if it's for the first 3 reasons of those 5 reasons we talked about above, so if it's the first 3 relating to the individual, then it's up to 500 a day for up to 2 weeks. And it's actually an 80-hour requirement. So it doesn't have to be, of 500 a day. It can be 50 hours in 1 week, 30 in another week. It's not so much 2 weeks as it is based on the hours. On the family leave provision, again, it's 10 weeks, but the pay is slightly different. It's not the wages up to 511 a day like on the sick leave. Sorry, let me go back to the sick leave. So if it's the first 3 reasons, it's up to 511 a day. If it's the last 2 reasons, they're caring for someone else or a child, the employee gets up to 2/3 of their pay, regular pay, up to 200 a day. So it's much less generous if the employee is caring for somebody else. They can't work because they're caring for somebody else than if the employee themselves are sick. On the family leave side, they mimic the last 2 reasons. So for everybody who gets family leave for the 10 weeks, it's no less than 2/3 of your pay, up to 200 a day. So it's less generous again than the sick pay provision in terms of the amount that's reimbursable to the employer. We'll go to the next slide, please. The law took effect May 1st. It goes to the end of the year, and then it sunsets, and it's not cover sick leave paid before that time. And so we don't get many questions on that anymore. That was more when the law was first passed. Next slide, please. There's no net cost to the employer, so the 100% of the benefit that's paid to the employee is reimbursed through the federal government through the refundable tax credit, which is offsetting employment taxes and/or get an advanced payment through that Form 7200. So we'll turn now to the next slide. I think this is just the mechanism we talked about before. It'll be a quick mechanism, the Form 7200. Let's turn to the PPP and the loan provisions now. So we're going to talk some SBA assistance. So there's 2 principal lending provisions that were enhanced by the CARES Act. So this first is the EIDL, the Economic Injury Disaster Loan Program, and the second is the PPP. On the first one, the EIDL, we'll spend much less time on that because there's 2 aspects to it. There's a loan and there's a grant. The SBA, when you apply, within 3 days of applying, the SBA will make a decision on a grant. A grant is an outright gift of money that does not need to be repaid. It's up to $10,000. We're hearing informally that the SBA is limiting this to $1,000 per employee. So if a business has 3 employees, the maximum grant they would get is $3,000. On the basic loan, on the loan aspect of the EIDL program, or the EIDL program, as some people call it, it's used to pay fixed debts or payroll, accounts payable, and other bills that the taxpayer is having trouble paying as a result of COVID-19. And this loan, it allows up to $2 million, but we're hearing again that the SBA is capping this at $15,000 for many people. So in reality, it's a $15,000 loan. It can be repaid up to 30 years. It's a much longer term financing, which is nice, as the PPP is an only 2-year loan. And the grant is up to $10,000. So it's 25 max for all practical purposes on the EIDL loan program. Next, we'll turn to the PPP, which is where we'll devote much of our time, because this is really where the taxpayer can get a loan for 2 years, but also forgiveness. So on the eligibility, Many taxpayers I know I understand on this call have not received a loan yet, so their eligibility is an important concern. It applies on the tax exempt side. It applies to 501c3s and veterans organizations, which I believe is C19. But the C4s, 5s, 6s, the other ones are not eligible for a PPP loan. And as far as I know, I haven't seen the bill yet, but I do not believe they're expanding that in the second part of the legislation that's about to be signed today. But I haven't seen the bill yet, so I can't confirm that. So it applies if a company, there's three ways into the PPP. The first way is if the company has 500 or fewer employees, and that's, you have to take into account certain affiliation rules to make that determination. So if a company is owned by a larger company, 100%, you'd have to add the employees of both companies. So the affiliation rules are extremely broad, but what they do is they aggregate two or more companies for purposes of counting the 500 employees. And so if a company is owned by a private equity firm, you'd have to include the other companies owned by that private equity firm. They use a control test, which looks at ownership and common management and major contracts between them. It's well beyond the scope of this presentation, but they're out there. The second way is if a company has more than 500 employees, but they have an NAICS code, which is a code that allows a national association of industrial codes. I forget what it stands for, but there's an NAICS code for each industry that's out there, and they set these alternative size standards. And so if your industry has a size standard of 1,000 employees, you can have 1,000 employees and still qualify for a PPP loan. Third way is if you meet this tangible net worth standard. So if you have a maximum tangible net worth, which is assets minus liabilities minus intangible assets like goodwill, that's why it's a tangible net worth, is worth more than 15 million, and your average net income is not more than 5 million for the last 2 years. So that's that third test, the net worth test, which has the two parts to it. Sole proprietors, independent contractors, it can apply separately from the business. They apply separately for their own loan, and we mentioned affiliation rules. So turn to the next slide, please. The terms, this is a key part here. To one loan per person, you can't get two loans. In general, the maximum loan amount is 10 million, but it's based off your payroll costs, which is a defined term. Very loosely, payroll costs are the wages you pay your employees, up to 100,000 per person, plus certain rent, utilities, and interest on mortgages. And you take 250% of that, so 2.5 times your monthly payroll cost, and that determines the size of the loan. So if your monthly payroll is 100 grand, you'll get a loan for 250,000. And at the high end is capped at 10 million. The borrower submits its own payroll calculation. The lender just reviews it. The lenders are not really underwriting these loans. They're not doing credit checks, and they're not doing reviews of financial statements. It's what one underwriter described it to me as they're processing applications, not underwriting loans. And so they're reviewing the borrower's calculations, they're processing them and submitting them to the SBA for approval. So you're going to apply to a lender if you get the loan. It's a 1% interest rate, so extremely low interest rate. It's a 2-year loan, no collaterals required. It's fully guaranteed by the SBA. No personal guarantee is required. There's no prepayment penalties. So it can be prepaid at any time, and there's no payments due for the first 6 months, although interest will accrue from the date the borrower obtains the money. So the next slide, please. What are payroll costs? We talked about them. Again, that's defined in the CARES Act. It's employee comp up to $100,000. So that's the wages, salary, vacation pay, medical pay, dismissal, separation payments, group healthcare benefits, retirement benefits, and state or local taxes on the employer relating to the compensation. It does not include the employer's share of federal taxes. It does not include employees who work outside of the U.S. or principal place of residence is outside the U.S. And it does not include wages that are, again, being funded through those sick and family leave credits we talked about under the Families First Coronavirus Response Act. So again, they're trying to prevent double dipping here with the various benefits. We'll go to the next slide. There's a difference between allowable and forgivable expenses. And so the SBA has, and the statute says you can only use this PPP loan for certain allowable uses. And any use beyond that would be an impermissible use and violates the terms of the loan agreement and presumably could subject the borrower to fraud penalties and that kind of stuff. And so they don't want you taking the money and using it to buy pets, for example, or to pay personal expenses. It's for business use. And so there's a list of allowable expenses. I just highlight here, I won't go through them all in the interest of time, but the forgivable expenses is a narrower list. And so you have to, the forgiveness period is 8 weeks after the loan is funded. It starts on the date that the taxpayer receives money under the loan from the bank, and that's when the 8-week period starts. And so all forgivable expenses paid during that 8-week period are subject to forgiveness, meaning the taxpayer will not need to repay the lender those amounts. So it really is a gift from the government to the borrower. And one way it's been described is unemployment on steroids. And so what the real purpose of this legislation was to prevent the unemployment rolls swelling beyond what they knew they were going to. I think now it's been like 23 million people have been put on the unemployment. Well, that number would probably be more than double if this program were not in place. But this program is intended to mimic unemployment. It's just paid through the employer. And so the government pays the employer and the employer pays the employee. You can go to the next slide, please. The borrower does need to make certain certifications to get the loan. The first one's the most important. I'll focus on that. That the current economic uncertainty obviously related to COVID-19 makes the loan necessary to support your ongoing operations. And so yesterday, the SBA issued a frequently asked question that they knew this question was going to be read and reread millions and tens of millions of times, and yet there's like so much ambiguity in this thing. But what they're trying to do is saying they're trying to address the Shake Shacks of the world and the Ruth's Chris who got these $10 million loans, and they're big companies, and the SBA doesn't think they need them, even though they fully qualified under the Act and the SBA's regulations. They just didn't think that these companies needed the money. So they came out with this sort of frequently asked question. They added it to the list. I think this was number 31. It's an ongoing list that they keep on the Treasury website, SBA website. It came out yesterday, intended to create sort of this interim effect to discourage large people who have access to capital from applying for PPP loans, trying to limit it to smaller businesses. And so I put it here. I highlight some of the important provisions. It's out there. It's if you're a larger business, you really need to focus on this representation, this frequently asked question, to make sure you qualify for a loan and not one of these larger businesses. So the next slide, please. Loan forgiveness. Again, this is what it's all about. This is what why everyone's taking out the loans. The 1% interest rate for 2 years is very nice and attractive, but the forgiveness is free money, and they're paying for your employees. So you really want to try and maximize this forgiveness, and this is what everything's about. This is why you've probably seen a bunch of forgiveness calculators on the internet by now. We just caution people. We've built our own calculator. We decided not to put it online yet. There's so much uncertainty out there. We have reviewed some calculators just to see how other people are interpreting the rules. We've noticed significant errors in calculators, even that were put out by major organizations. So I just caution you, be careful with these calculators. The rules, even though there's uncertainty on the rules, there are some things we do know, and these calculators are incorrect, the ones we've seen. We have yet to see one on the internet that is completely correct, at least based on the rules as written. But so what are the expenses? What you do is you calculate a loan forgiveness amount, and then there are certain reductions, and I won't go through this. I know we're running short on time here of the presentation part of this webinar. But if in the event that you reduce headcount, you reduce your number of employees, FTEs or full-time equivalents relative to a base period, they reduce the loan forgiveness amount. Same thing with wages. If you pay employees less than 75% of their wages in the base period, they reduce the forgiveness amount. So this is why we say to people, you really need to look at what you're paying your employees and the number of employees. You really want to bring them back if you let them go. And you want to rehire them because there's a rehire rule on the bottom bullet there. If you bring them back or if you restore the headcount or wages by June 30th, you can eliminate any of the reductions. So these are very important, these rules in determining the amount of forgiveness, because it's a multi-step process determining forgiveness. But in a nutshell, you build up the forgiveness amount with your expenses paid during the 8-week period. Then you reduce them by any headcount reductions, any wage reductions. So that's a sort of big picture how the calculation works, but there's a lot of nuance and detail. And what we're doing is a lot of times we're running scenarios for people, saying, because there are some non-obvious conclusions that you reach when you run various scenarios on how many people you bring back, how you pay them, and when you pay them, and when you pay bonuses, or if you can pay bonuses, that kind of thing. So there's a lot of, although it's simple to state the rules, it's very difficult to apply them in practice, given the level of uncertainty in the rules and the detail. I will say that we expect guidance from the SBA very shortly, if not within days, regarding the forgiveness calculation. And at Withum, we've posted three articles on the topic. One, sort of how the rules work in general. Two, and our second article is one I wrote, which was about all the problems with the calculation and the things we don't know and the uncertainties and things that don't work. So the one was the general rules, two is all the problems, and three is whether you should segregate the funds in a separate bank account rather than combine, putting the loan proceeds in your operating account. And we do recommend that for people to keep an audit trail of how the funds were used and to make sure there's no problems later on questioning the use of funds. So go to the next slide. And we turn now to the question and answer period. I hope I didn't go too fast with all that, but we'll turn it over to, I guess, Scott. Are you leading us off here?
I'll read some questions here, Dan. Thank you. And so I'll read the question over to you here, Scott. So I was looking through, and I think I combined three that are relatively the same. So there's three different parts of this. Practically speaking, how does the employee retention and payroll deferral credit work? How do we get the money? Do we just remit our payroll taxes, or do we just not remit our payroll taxes? Which one of those? And the final piece of that was, what if we outsource payroll processing?
Yep, so it's a good question. It's the one that we get frequently. I think Dan touched on a couple of the pieces here, but the first thing you want to do is that, to the extent that you outsource your payroll, you want to contact your payroll provider and tell them that you're eligible for the employee retention credit and the payroll deferral credit, and that you want to take advantage of it. Working with some clients, we've seen where different payroll companies some are more prepared for this than others, and I think that all of them are getting on board with this as we're now several weeks out from when these laws passed initially. Some were quicker to be ready to go. As far as the payroll deferral credit, what we've seen is that, so that's really just a click of a button. You let your payroll provider know that you want to take advantage of that, and they will turn off your employer's portion of payroll taxes, and it's as simple as that. And they will handle the 941s and properly report what goes to the government. If you do it internally, then you just need to make these adjustments internally. We know there's some, especially on the local union side, number of folks may have a payroll software that's part of their general ledger package, and they're just going to have to do some more manual work in terms of that. And as Dan mentioned, if your amount that you are eligible for exceeds how much you would otherwise send the government, there is a form 7200 that's available online. You can just Google it, and that allows you to put in and submit that to the government and say, hey, I'm eligible for a greater credit than I would otherwise pay. So please send that back to us. So again, to help with cash flow to get those monies back as quick as possible.
All right. Scott, I'm seeing another question come in. I am a plan administrator for a large standalone pension plan. Are these programs available to me?
Yeah, so unfortunately, when the law first came out, we were optimistic that all of our clients were going to have an availability to take advantage of these programs. And what ended up happening, and it happens quite frequently, is that pension plans, because the way pension plans are created, they're statutorily exempt from taxes under a unique, or rather somewhat unusual code in the IRS. Their pension plans and retirement plans are exempt under 401A of the code. And when these rules were written by Congress, we don't think that they were intentionally excluded. We think that they were just forgotten to be included, because what the law says, what the CARES Act says, is that the specifically the PPP and the employee retention credit and the EIDL, the disaster relief, those three programs, they specifically say that those are eligible for employers, nonprofit employers that are exempt under 501c, which captures the majority of not-for-profits out there. But unfortunately, because retirement plans are unique and they're exempt under 401a, retirement plans are not eligible for those three programs. They are still eligible for the deferral program, and they would also be eligible for the Families First CARES Act, which is the sick and the long-term family credit.
Okay.
All right. Here, a question for the deferral of the 6.2% of employer share of the Social Security payroll tax. Can we pay the first half of the installment right on December 31st, 2021? I believe the answer to that one, Dan, is yes, that first, as long as it's paid by or on December 31.
Correct. Again, that will, if you do that, though, you won't get it. I'm not saying it's material for most people, but you won't get a deduction for the payment until 2021. If you want the deduction in 2020, you can pay it a few months sooner. You can speed that up, but you certainly can pay it by that date.
Yeah, I think that's what we would recommend our clients. Fortunately, the majority of the audience are tax exempt organizations, so the deduction component isn't as relevant for those folks. So yeah, so that would, I believe that would be our recommendation, Brian, would be to have that paid at the end of the year.
Yeah.
So Scott, this question's for you. And Dan, you spoke about this a little bit earlier when we talked about the shutdown and what a shutdown means. What does it, can you go into a little bit about what it means to be partially shut down? And can you speak on if we've had to vacate our office or just kind of what it means if we don't work as efficiently as home? Does that count as being partially shut down?
Yeah, so as I interpret it with in terms of what a partial shutdown means, as Dan said, it's I think it's a pretty liberal comment that is in the law. And you know, a lot of the clients that I know are participating in this, and the ones that we work with, they're in urban areas, and a lot of those urban areas have been shut down, and people have been restricted access to their offices. And frankly, a lot of people just have not wanted to go in the office, even if they are deemed essential, because they don't feel safe in these times. And so I think that anything that is a disruption to your otherwise normal business workflow, I think that you can make a strong argument to say that that's a partial shutdown or a something that has impacted your business operations. So I think that most folks, I would believe, would likely have a significantly strong argument as to the fact that they have been partially impacted. Most of the clients that we work with, again, and likely those on the lines, they would not qualify for the receipts component of it, because I don't think most of our clients have quite felt the 50% reduction that Dan talked about. So you would have to more take a look at has our business operation been at least partially impacted from specifically as a result of COVID related shutdowns.
Okay. Yeah, I would just add to that. I agree with all that. I would just add that we are recommending people document the shutdowns. The way the rule's written, and this is all up on the IRS website. You need to document how the government limitation on travel, group travel, or meetings has impacted your business such that you're not able to operate at normal capacity. So what we're just recommending is people create a memo or email documenting the shutdown order, the effect on the business, and the exact impact it's having. It's easier to do that now while the facts are fresh in your mind, rather than on audit 2-3 years from now when the IRS comes and asks you why you believe you experienced a partial shutdown, particularly if the rules become stricter over time and the IRS is challenging these things more aggressively, forgetting what the uncertainty that prevailed at the time and the business environment in which people are taking these credits.
That's fair.
All right. I think, Dan, this one may be one for you. It's relative to the new FAQ 31. How concerned should smaller 501c3 and other entities be with a necessity certification for the PPP? For instance, what if the entity has reserves What if layoffs or reductions in compensation are not imminent, but possible in the future, say in 3 to 6 months or longer?
Yeah, I mean, that's a great question, and it's something I've been talking to clients about from the very beginning. And I think it's hard the rep is very broad as written, right? Necessary to support your ongoing operations. It doesn't need to be your last dollar of funds, right? And so I've always said, if you have, for example, if you have payroll of 100,000 a month and you have 5 million in the bank in cash, it's hard to justify a need for this loan. And I think what the FAQ did was it tries to scare people, and it says it's written in a weird way because um, it talks about a company, a business that's owned by a larger company. And so it doesn't even seem right, but it doesn't talk about in a business owned by an individual. What if you have a billionaire owning a business, right? They have access to capital. And so I think they purposely left things vague. And the way it's written, it talks about a public company. Well, a public company is not owned by a larger company, right? It's owned by shareholders. And so I think I think it's either very poorly written, which I don't think is the case, or it's intentionally written in an ambiguous manner to create sort of a zone that people will hopefully stay away from, at least in their point of view. So to the extent a organization that, you know, a C3 or whatever has reserves set aside, and those reserves are ample to support the business at least for the next year or two, that's something they need to consider. And it's something they need to factor in whether they want to get the loan or not. I mean, the reason this FAQ came out was because of statements by Secretary Mnuchin and Senator Rubio, you know, criticizing people for taking the money. The FAQ does allow a grace period up until March 7th for companies to return the money. And basically it says, we're not saying you're lying, we're not saying you're wrong, but if you return the money, we'll forget about it. And we won't come after you, essentially saying we won't come after you. You'll be deemed to have satisfied this rep, and you don't even need to worry that we'll come after you. Unfortunately, it's very vague. You need to assess your individual circumstances and really evaluate the true need for the financing in your business, in your organization, rather.
Okay. This one's for either of you gentlemen. Do you have any recommendations for the best way to proceed about applying for either the EIDL or the PPP loans?
Let me stab at that first, because I can share with you what we've done with multi-employer plan community. And so most of the folks that have been eligible for these programs, at least the PPP, have been only the 501c3 clients that we work with, and that mostly, I believe, is confined just to training funds, related training funds. And so the best recommendation I have is become very close with your lender as quickly as possible. I know what I've read in the new bill that's come out is that I believe that they have the big gripe with the first round of funding was that it went to a lot of large organizations and went to a lot of large banks. The clients that we have had success with went to much smaller lending institutions that they had relationships with. And I believe in the newest round, they've actually segregated some more money specifically to smaller lending institutions and/or companies that may not have strong banking relationships. So that would be the number one thing that I would recommend that you do. And as Dan said, the money's going to go quick. So if you haven't started, get on it as quickly as you possibly can, because eventually they're going to run out probably fairly quickly.
Okay.
Okay. Scott, this is one that came in when you were talking about the first question on the on the employer retention credit and payroll deferral credit. Are labor unions as a small employer entitled to any of those benefits?
Are labor unions for the employee retention credit? Is that the one you were mentioning, Brian?
It came in, I wasn't sure if it's talking about everything covered today or during the payroll deferral credit or the ERC.
Yeah, so labor unions are available to take advantage of all of the programs with the exception of the PPP. Labor unions are 501c5 organizations. So other than that, they are eligible to participate in all of the other programs that we discussed today.
Okay. This next one's for you again, Scott. Will labor unions and/or multi-employer plans be eligible for the PPP in the next round of funding that's passed by the House and the Senate? And if so, what advice do you have for the first priority?
Yeah, as Dan mentioned, I think earlier, I've been trying to peek online today preparing for the webinar, and I haven't heard or seen anything that suggests that they've expanded eligibility to a larger audience, which for the nonprofit community is only 501c3 organizations currently. As a member of the Maryland Society of CPAs, I did get an email last night from the gentleman that runs that organization, and he said that he didn't think that was going to happen either. So we'll certainly get back to you, and we'll be blasting out information immediately if we do find it does expand to this client base. But I'm unfortunately, I'm not optimistic.
Got it.
Here's in the PPP, does the $100,000 cap include state and local employment taxes?
No, the answer is no, it does not. And I apologize, my phone keeps ringing here. That's me, not Scott. It won't even stop. So it's funny, I did unplug the phone and then the fax starts ringing. The cap applies to the salary component only and not to the other items. So it's 100 people. A lot of people say 100,000 plus. It's 100,000 in salary plus benefits plus retirement plus the state unemployment taxes or state employment taxes. Usually that's state unemployment, but if there are other state employment taxes that apply, they're part of the plus.
Yeah, I suspect the IRS is trying to reach you. That's why your fax.
That's right. Yeah.
Yeah, and the thing I'll add to that is that what we've seen with a few of the applications we've helped with is that some of a number of our clients, the retirement benefits into a defined benefit plan are based upon, it's a percentage of compensation. And while the amount that you're able to claim in terms of payroll on the wages side is 100,000, even if you make over that and your employer pays percentage of that, you can still go all the way up to whatever somebody made in total. That does not need to be capped by the $100,000. So on the retirement plan side, those contributions that the employer actually pays to the retirement plan, they're not capped.
This next one is for either of you gentlemen. If you are an officer of a union, can you briefly mention the key areas of the CARES Act available for the members?
Sure. So the big ones that you all, I'm sure you're aware of, you've seen in the news, like one of the biggest one was the stimulus check that went out to all individuals with a cap on a wage cap. So I've talked to many folks, families and friends that have already received those. So the stimulus was a piece. The other one that I'm sure hopefully your members haven't need to deal with, but if they have been affected and been laid off, unemployment was exponentially expanded in two ways. The biggest ways is that typically unemployment is for a 26-week period. The CARES Act expanded that to 39 weeks, so it allows people to be on unemployment for a longer period of time. And then the second piece is that whatever your regular unemployment wages calculate out to be, there's an additional $600 that is added as a result of the CARES Act to that unemployment amount, which, you know, I've heard has put a number of employers into precarious positions, because some folks that have gotten the PPP and are trying to get their employees to come back to work, if their unemployment benefits, because of that extra $600, is causing them to make more than going back to work, it's put a number of employers into precarious positions. But those are the two big pieces that are available to workers that have been unfortunately negatively impacted as a result of this.
All right.
Thank you.
I have one. This maybe for you, Dan, with your experience on the prior webinars here. We are located in New York City and provide monthly transit and parking to our employees. Can we suspend those or get credit for what we did not use in the past? What may others be doing?
Yeah, you can suspend it subject to your administrator doing that, but I don't believe you can go backwards. So we started advising people, as Brian mentioned, over a month ago, 2 months ago, to consider suspending the particularly the use it or lose it, the monthly passes that are use it or lose it. Others are just money accumulating on a car that has long-term benefit. So they can be suspended, and it's a matter of reaching out to the employer, indicating you want to suspend, and hopefully they can then go to the administrator and have a process to shut these off.
All right. This one, Scott, I think would be I pieced a couple of different ones together. It says several contributing employers said that the PPP loan forgiveness wasn't guaranteed, like everyone said in the news, so they wouldn't apply for our members. Is this true? And some of the other sort of components of that, if so, are the factors controllable by the employer? Why or why not? What happens if the employer wants to bring everyone back on payroll, but they make more on unemployment? How does this impact loan forgiveness?
So I'll start at it, and then Dan can jump in and bail me out here with some more of the specific PP details. So I think where, and I've heard that has been a case before, and I think where the challenge there is that while the PPP covers a lot of costs, it may not cover all costs as it relates to having to deal with some particular jobs. And so I know we want to have every single one of our members working and put back on the rolls. Employers may incur some costs that fall outside of the allowable, forgivable pieces, and that may be one of the reasons why an employer would consider not going for a PPP loan. Dan, I don't know if you have any greater insight in terms of the instance I referred to as what happens if you can't get your employees to come back because their unemployment is greater than what they were otherwise being paid, and
Sure.
an employer receives a PPP, what do they do?
Yep. So on the PPP loan, it behooves every person to get it. I would say the fact that they're not going to get full forgiveness is not a reason not to get the loan. It's just they'll get less of, if you get less forgiveness, as long as you plan for it and you expect it, you'll have the additional funds to return to the government, and you repay the loan. It's a 1% loan, which is virtually free money. So I think that companies should apply for the loan. They need to manage the forgiveness calculation. That's very important. I think a great number of businesses are going to be surprised that they're going to pay these expenses. They're not going to get the forgiveness they expected, and they're also going to have to repay the loan, and it's going to create additional hardships down the road. And so we are really stressing people to reach out to their accountants or model it themselves, reach out to someone who can model it for them, because they don't want to get stuck holding the bag when they have paid out all the money in salaries and overhead expenses, yet they still have to repay a significant portion of the loan to the bank. So that's that part of the question. On the unemployment piece, it's a difficult situation when the employee doesn't want to return because the employer gets forgiven. So the other question was, is it in the employer's control? The answer is yes. The employer has full control, almost full control over how much forgiveness they get, and that's through managing the costs they pay and managing the process of bringing people back and paying out enough in payroll and overhead to get the forgiveness. Now, if an employee doesn't want to come back, puts the employer, it kind of creates a pickle, right? The employer wants to pay them to maximize their forgiveness for everybody and for the employer, and you need to bring your employees back. If the person doesn't want to come back, here's the employer's remedy. They offer the person a job, presumably in writing, so they can document it. Then they now put the ball in the employee's court. If the employee refuses the job offer at a comparable wage from their old wage, they're now ineligible for unemployment. That doesn't mean the employee can't commit fraud, right? They may just ignore that and continue their unemployment and go on their way. However, it is illegal to do it because they have an obligation to notify the state unemployment office that they've received the job offer, because at that point they're voluntarily unemployed, right? It's not against their will at that point. It's voluntary, and you're not subject to unemployment for voluntary. You don't get benefits for voluntary unemployment. So let's say the employee then says they say no. If they say yes and they take the job back, then the employer just pays them, right? Bring them back on the payroll and start paying them the benefits. The employee may not be happy that they're making less, but they do keep their job. And maybe I'm just a long-term thinker by nature, but I would have thought that's more valuable to the employee and know you have a job in 4 months, in 3 months, when the economy is really going to be in the throes of a recession, than getting a few extra weeks of unemployment at a slightly higher rate. But maybe that's just my own view. So the employer then brings the person back, they pay them the wages, and hopefully get forgiveness for everyone without reduction. So that's the remedy. What if the employee doesn't want to come back? The employer, their unemployment rate, the rating will go up, and they'll have to pay more higher rates in state unemployment insurance. So they could, if they wanted to be, tough about it, they submitted it, they offered the employee in writing. The employee doesn't come back or doesn't respond. Most likely won't respond, right, if they're not coming back. The employer then could write a letter to the unemployment office and indicate and copy the employee saying, I offered this person a job. They said no, or they didn't respond to me, and I believe they're now ineligible for unemployment. The employer, it's not nice to have to do that to an employee, but it is going to affect the forgiveness calculation. And the purpose of this legislation was to keep people on the employer's payroll, not to have them go on unemployment. Unemployment was the backstop to the PPP, which was keeping everyone at their current job at their current wage. So it's a bind. I can present the options, those are the options the employer has. They're not great, but the goal is that you want as many people employed as possible, and to model these scenarios out. If you think a certain number are not coming back, you need to analyze the date they left, if you can rehire them, replace them with someone else. These are all things that go into your forgiveness calculation, which is very important. Again, we don't want to see people stuck having paid wages or paid out the loan and then still have a repayment obligation, because if the quirks of the forgiveness calculation result in an amount of forgiveness less than the full loan amount. And that's entirely possible. And I hope I stressed that enough on the call. It's not about generating work for the accountants, because we don't expect for this to be the full employment act for accountants. But this is something that a small amount of time with a qualified expert can save you a lot of pain down the road.
Thank you, Dan. And that ends our hour. There's a few other questions here in the queue. We'll reach out to everyone who submitted them and provide you answers back. And I thank you all for listening in and for your Friday afternoon hour. And if you have any additional comments on the last slide, you can feel free to reach out, Scott or me, and we can provide some additional details, and we'll also share the slide presentation. So thank you all, and continue to stay healthy and safe, and take care.
So long.
Thank you, everybody.
Thanks, everyone.